Let's begin by telling you that the Central Bank of Nigeria has raised the monetary policy rate by 50 basis points from 26.25% to 26.75% in response to soaring inflation and skyrocketing food prices. CBN Governor Olayemi Cardoso announced the increase on Tuesday during the Apex Bank's 296th Monetary Policy Committee meeting in Abuja. The MPC also set the cash reserve ratio for deposit money banks at 45%, while merchant banks will see their CRR adjusted to 14%. The liquidity ratio has also been set at 30%. The MPC meeting is convened to assess the country's economic and financial conditions and to determine the appropriate monetary policy direction for the short to medium term.
The committee's decisions are as follows. Raise the MPR by 50 basis points to 26.75% from 26.25%. From 26.75% from 26.25%. Adjusted the asymmetric corridor around the MPR from plus 100 to minus 300 to plus 500 to 100 basis points. Retain the cash reserve ratio of deposit money banks at 45% and merchant banks at 14%, and retain the liquidity ratio at 30%. Okay, ultimately, if we're doing all the things we're doing and we're not able to impact the man on the street, ultimately, then what do we really say we've been doing? And I think sometimes when people look at figures too often, they may lose track of that. And that is why I said what I said, that it is so important that we continue to bear that in mind, that our policies must ultimately impact the man on the street.
To discuss this, I'm joined by the Chief Economist, ARKK Economics and Data Limited, Samson Simon. Hello, Samson. Good morning, and thank you so much for joining us at this time.
Good morning. Thank you for having me.
All right, Samson, break it down for us so the common man can actually understand. What exactly happens to business when interest rates are increased?
Well, what the central bank actually delivered yesterday was the benchmark interest rate. It's not the direct lending rates now. So the financial institutions will tweak whatever the central bank gives in such a way that they will determine the prime lending rates and other lending rates. So by the central bank hiking interest rates, the monetary policy rate, by 50 basis points, that implies that the financial institutions or banks in Nigeria will also increase the lending rate. So if a bank had loaned you money some time ago and they were asking for 40%, now they are going to increase it. They are going to send pieces of they will send letters to those people concerned that because of the increase in the monetary policy rate now, or we are going to charge you extra for that money we lent to you some time ago. So it's going to become more expensive to borrow, whether for businesses or for individuals, and that will discourage those entities from borrowing. Since it's going to cost them more, they have to pay more in interest now. Okay. So definitely that will be discouraging to businesses.
All right, but in that case, Simon, how do you think the increase in MPR from 26.25% to 26.75% will impact borrowing costs for businesses and also consumers in Nigeria?
By discouraging, the objective, the result you try for the existence of the central bank is price stability, is to protect the purchasing power of everybody, whether businesses or individuals. And what they're trying to do by hiking interest rates is to reduce the amount of liquidity within the economy. And now that they've increased it, people will be discouraged to borrow. So there will be less spending. And when you have less spending, that will ultimately impact on inflation rate. And we know our inflation is beyond crazy. 34.19 is completely off target. The ideal for Nigeria is 6 to 9%. Globally, the ideal is even 2%. And we're doing 34.19% official figures. Some authorities even have some figures that are way higher. So everything must be done to bring price back to target. And that's what the central bank is trying to do.
All right, Samson, you did say that, the idea is to reduce liquidity, which will in turn lead to less spending. But with the liquidity ratio now pegged at 30%, how do you foresee this affecting lending activities and the overall economic growth in Nigeria?
Well, the liquidity ratio has been 30% for a while. That was not tinkered with. The central bank did not adjust the liquidity ratio. Okay. It only adjusted the anchor rate and also the asymmetric corridor around the anchor rate. But for the liquidity ratio, it has been 30% for a while, and it was increased to that level, all in a bid to also reduce the amount of liquidity. All in a bid to mop up liquidity from the system to discourage too much money pursuing few goods and services, which we know is the layman's definition of inflation.
Okay. Now, just before we let you go, Samson, given the current economic conditions in Nigeria, do you think these monetary policy measures are sufficient to address inflationary pressures and also efficient to stabilize the economy?
Well, for inflation, inflation in Nigeria is on a tear. It has been climbing aggressively, and it has priced out almost everybody. There's no country on earth where inflation will be at more than 30% official statistics, and people will not be growing. So it's beyond bad. And the monetary authorities have done their own bit. Sadly, we have not seen much, particularly around inflation. I know that has helped with attraction of foreign portfolio investments, which are up by more than 234%. And also that has helped with diaspora remittances. Year on year is up by 62%. It has also increased our reserves. We are talking about 37 billion now, which is a month's high. So it has helped with certain things, but the main problem still remains that inflation. And so far, we have not really seen much to write home about. And that doesn't mean that we should not, that the monetary authority should relent. There's a need, because monetary policy actually has a long and variable impact or lack.
Okay. All right. Well, thank you so much, Samson, for taking time out to speak to us on this, and we appreciate you for your time.